Welcome back to Islamic Finance Unboxed. For decades, there has been a dream of building a fully Islamic economy. A financial world without interest, without speculation, and without debt traps. An economy rooted in justice, fairness, and shared risk. It's a powerful idea. It inspires scholars, politicians, and entrepreneurs alike. But here's the real question. If the model is so powerful, why don't we see a single fully Islamic economy in practice today? Why has the dream remained only partially fulfilled? In this episode, we'll unpack that question. We'll look at history, structural challenges, political barriers, and the reality of global markets. And finally, we'll ask, is a fully Islamic economy even possible, or is it more of a guiding vision than a destination? Historical promise. Let's rewind to the 1970s. The oil crisis changed everything. Petrodollars began to flow into Muslim-majority countries at an unprecedented scale. For the first time, many nations had the resources to experiment with alternatives to Western banking. This was the moment when modern Islamic banking was born. In countries like Saudi Arabia, Kuwait, and later Malaysia, institutions emerged promising to operate without interest. Scholars and policymakers argued that a new financial order could rise, one that would eventually transform entire economies. The expectation was bold. Within a generation, the Muslim world would have financial independence. No more dependency on the West. No more reliance on conventional debt markets. Instead, a self-sufficient system run on sukuk, mudaraba, and profit sharing. But 50 years later, while Islamic finance has grown tremendously as an industry, the idea of a fully Islamic economy, a whole nation running entirely on Shariah principles, has not materialized. Structural challenges. One of the biggest obstacles is structural. The global economy is built on the US dollar. Almost all international trade is settled in dollars. Oil, ironically the lifeblood of many Muslim economies, is priced and sold in dollars. Central banks in Muslim-majority countries hold their reserves in dollars. Their sovereign wealth funds invest in dollar-denominated assets. And global credit ratings, which determine how cheaply countries can borrow, are tied to institutions that operate under Western financial logic. So here's the dilemma. How can you claim to run a fully Islamic economy when your reserves, your trade, and your government borrowing all depend on an interest-based system dominated by the dollar? Any country that tries to break away risks economic isolation. And in a world of interconnected markets, no nation has been willing to pay that price. Political barriers. But the challenges aren't only structural. They're also political. The Muslim world is not a single economic bloc. It's fragmented. Some nations are rich in oil and gas. Others are heavily indebted. Some are monarchies. Others are republics. And many face political instability or even outright conflict. From the wars in the Middle East to sanctions on Iran, instability makes long-term economic planning incredibly difficult. Even where there is wealth, governance issues, corruption, and weak institutions slow down the progress toward a truly Islamic framework. Think about it. Building a fully Islamic economy would require unity, coordination, and trust among nations. Yet the Muslim world often struggles with political divisions that spill over into economic policies. Partial success stories. Still, it's not all failure. There are success stories, but they are partial. Take Malaysia. It has developed one of the world's most advanced Islamic finance sectors, with sukuk making up a huge share of its bond market. Or look at the Gulf, where Islamic banks hold trillions in assets and sukuk issuance reaches global markets. But here's the catch. These countries still run mixed systems. Their governments borrow through both Islamic and conventional instruments. Their people use both Islamic and conventional financial products. And their economies remain plugged into global financial markets that run on interest. Islamic finance is growing, yes, but it is not replacing the mainstream. It is coexisting with it. Critical view. This brings us to a critical question. Is the idea of a fully Islamic economy even realistic? Some scholars argue that what we call Islamic finance is itself a hybrid, a Sharia-compliant layer built on top of a global system that can never be fully Islamic. They argue that expecting entire nations to switch overnight is not just difficult, it might be impossible. Others suggest that the very definition of an Islamic economy is more about guiding principles, justice, fairness, transparency rather than about creating a sealed-off financial bubble. And in reality, even in Muslim-majority countries, most people continue to rely on conventional tools, credit cards, car loans, even mortgages. Islamic alternatives exist, but they don't dominate. Future outlook. But what about the future? Could the digital revolution change the game? Fintech, blockchain, and smart contracts open up possibilities that didn't exist in the 1970s. Imagine a world where sukuk are tokenized and traded seamlessly across borders, where smart contracts enforce Islamic profit sharing without middlemen, where central bank digital currencies can be designed with Shariah compliance built in from the start. Some believe this could finally give Islamic finance the tools it needs to scale globally without being locked into the conventional interest-based system. Others see it as a chance to leapfrog into a hybrid model, not a fully Islamic economy, but a world where Islamic finance becomes a mainstream choice, not just a niche. Let's close with something often forgotten in financial debates: the human factor. Every crash, from 2008 to the digital bubble, is not only about numbers on screens, it's about people. Families losing homes, students drowning in debt, entire nations tightening their belts. Conventional finance tends to separate money from morality. The system is designed around maximizing profit, even if the risks are pushed onto society. But Islamic finance, with its asset-based and risk-sharing principles, puts people back at the center of the equation. Take housing as an example. A conventional mortgage leaves the borrower carrying almost all the risk, regardless of economic downturns. In contrast, Islamic models like musharaka mutanakisa or diminishing partnership mean that both the bank and the family share in the outcome. It's not charity, it's fairness embedded in the contract. This human-centered approach is not just theory. It's why global regulators and economists are beginning to revisit concepts of shared risk, sustainability, and ethical guardrails. They may not call it Islamic finance, but the principles are strikingly similar. So when we ask why asset-based Islamic finance still wins, the deeper answer is this: because it remembers that money is a tool, not the ultimate goal. The ultimate goal is stability, dignity, and trust, values that any society, East or West, desperately needs when the next financial storm hits. So why do we not see a fully Islamic economy yet? The reasons are clear: global structures, political divisions, and practical realities. But maybe the real question is different. Maybe the goal was never about building an isolated system. Maybe the goal was about injecting fairness, justice, and ethical finance into the global economy. Because whether or not a fully Islamic economy ever exists, the principles behind it, risk-sharing, transparency, and avoiding exploitation, will always remain relevant. This is Islamic Finance Unboxed. If you enjoyed this episode, don't forget to like, subscribe, and share your thoughts in the comments below.